Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today in this lecture we will study Ind AS 12, that is income taxes. This will basically cover your chapter number 10, unit number 1 of your ICA module. Let's begin. Now where is this Ind AS 12 applicable? What is the scope of this Ind AS 12? So basically this standard Ind AS 12 applies to all the domestic and foreign taxes, all the taxes even if they are domestic or foreign, whether they are within India or outside India. Okay, it also includes taxes, for example withholding taxes. This is very much similar to as TDS, tax deducted at source in India, okay, which are payable by the subsidiary, associate or joint ventures on distribution to the reporting entity. Okay, now as you know, this Ind AS is derived from IFRS and IAS, and therefore these foreign taxes are also included. Okay, your example of withholding taxes therefore given because it has been almost copied or almost derived and converged from IFRS. Okay, so your example of withholding taxes therefore given. Now it includes accounting for temporary differences. It always accounts for temporary differences. Permanent differences are not accounted, arising from such grants and investment tax credits, and excludes method of accounting for government grants or investment tax credit. This means that the government grants accounting will be done as per their own specific standard, whereas the tax treatment will be taken under Ind AS 12. Okay. Next, current tax is the tax that is related to the current financial year, current reporting period, the current period. Okay, whereas deferred taxes are related to the future actions, future events, future profits. Okay. So current tax being current tax as a consequence of that arises due to transactions and other events of the current period that are recognized in an entity's financial statement, whereas deferred taxes are future tax consequences. These are current tax consequences, these are future tax consequences. Okay. Next, recovery of the carrying amount of assets or settlement of carrying amount of the liabilities that are recognized in an entity's balance sheet. That means any further any future event on settling up the liability or any acquisition of the asset. If any differences, if any incomes and expenses arise due to any transaction in future, then there will be deferred tax. Okay. Now this is always recorded on the basis of temporary difference. The other name for temporary difference you can say is timing difference, is simply the timing difference. What does this mean? Timing difference simply means the difference in the carrying amount and the tax base is just because of the timing. The entire, if taken as a whole value, is equal. Okay, for example, if you talk about accounting, okay, so as per accounting, the carrying value is depreciated in 5 years, whereas if we talk about tax purpose, okay, so for tax purpose the current value of the cost of the asset is depreciated in 7 years. Okay, so in total if you see, the whole amount is being charged to P&L, but the difference is the timing. Here it is charged in 5 years, whereas it talk about under taxation it is charged under 7 years. So simply there is temporary difference just due to timing difference. Okay, it is not permanent difference. Now this difference is of two types: taxable and deductible temporary difference. Taxable means in future their liability will arise, and therefore it is known as taxable temporary differences. This is normally recorded as DTL, deferred tax liability. Deductible means in the future, in the next upcoming time, you will be allowed to deduct something, and therefore there will be a benefit to you. If that benefit arises to you, then this is recorded as DTA, asset, since it is favorable because you will be allowed to deduct something in future. Whereas if we talk about taxable, here another liability arises, and therefore DTL is recorded as unfavorable. Okay, so if unfavorable, then liability recorded; if favorable, then asset recorded. If you are allowed to deduct something, then it is favorable, and therefore DTA. If you are not allowed to deduct something, instead you are charged with some liability, so it becomes taxable, and therefore it is deferred tax liability. Are you clear with this? Good. Next, this is always compared between the accounting profit and the taxation profit, or here you can say that carrying amount and the tax base. Okay, what is tax base? Tax base is simply the amount on which you charged the taxation. Okay, you can say taxable profits. So for example, if you talk about income tax, okay, direct taxes, what you do before charging the taxation, what you calculate GTI, you deduct the deductions eligible, and then you get a total income, that is taxable income, on which tax is charged. So simply the tax base over here is the taxable income. Okay, so here for calculating the deferred taxes and the current taxes, you always have to compare the accounting profit, that is carrying amount, and the tax base, that is taxable profits. Okay, good. Now deductible temporary differences arises when the carrying amount of a liability exceeds its tax base, or tax base of an asset exceeds its carrying amount. Taxable temporary differences arise where the carrying amount of an asset exceeds its tax base. Okay, so it is very confusing right now. We'll see a chart and you'll learn that chart. Okay, see, if carrying amount is greater than tax base, if carrying amount is greater than tax base, then you have to see whether it is favorable or not. If you are talking about asset, then you will consider it as taxable temporary difference, and therefore you will record liability. Taxable means liability, deductible means asset. Again, see, taxable means liability, deductible means asset. Okay, so if you have a carrying amount which is greater than tax base, you have to record as deferred tax liability. Okay, and for liabilities part, okay, if liability, then you have to calculate deferred tax asset. Now if carrying amount is less and tax is more, okay, if carrying amount is lesser and tax amount is greater, then if for asset, you have to see deductible means asset, DTA, and here for liabilities it is taxable, and therefore liability increases, and therefore it is calculated as DTL. Firstly, you have to make a connection between taxable and liability, or you can say DTL, deductible and DTA. Okay, now you have to check whether it is for asset or whether it is for liability. Next, you have to check whether the carrying amount is greater than tax base or whether it is less than tax base, and accordingly refer this chart and record. When the amount of difference is nil, that is carrying amount and the tax base is equal, then what you do, you need not to record and calculate any amount. No temporary difference, no temporary difference. Okay, are you clear with this? Now read this, you will get a better understanding. Okay, next, tax accounting. Now in case if an expense is related to other comprehensive income, then that particular tax is also charged. The particular tax related to that particular income and expense is also charged to OCI. If it is related to equity, then particular is charged to equity, and if it is related to PL, then the particular tax related to such item is also charged to PL part. Okay, this is very important point. Next, the differences. If it is temporary difference, it will either arise DTL or DTA. If deductible, then DTA. If taxable, then DTL. Other than temporary changes, you do not have to record anything. You do not need to reverse out anything. For example, a note is given. If the land is not going to be sold in the near future, okay, and particularly in business, and then in such case, it is not advisable to calculate temporary differences. Okay. Next, Ind AS 12 deals with the recognition, presentation and disclosure of income tax. Ind AS 12 itself guides you how to recognize, how to measure and how to disclose the income tax in your books of accounts in the financial statement, so as to make it compliant with Ind AS as well. Okay, Ind AS 12 itself tells you how to recognize, how to present and how to disclose the information related to income tax. Next, offsetting of current tax assets and current tax liabilities. Generally, it should be shown separately, but offsetting is allowed only when it is permitted as per the law, and secondly the entity's intention is also to set it off on net basis. Okay, an entity shall offset, that means shall offset charge one to another and show the net amount, current tax asset and current tax liabilities if any, only if the entity, if and only if the entity has legal permission, is legally enforceable to do so, and has intentions to show that particular and settle that particular amount on net basis. Okay, so there should be legally permitted, enforceable, and secondly there should be intention of the entity to record and do in on the net basis. Okay, next, deferred tax, its recognition and measurement and presentation have 10 important steps. You just need to read it out, you will get a little glimpse of it. You do not need to learn or cram about that. Okay, so step 1, what you will do, you have to compare the carrying amounts, that is accounting profits, and the tax base. Okay, so you will calculate and compute the carrying amounts and the tax base, then you will compare them, compute the temporary differences by comparing them. Now classify this whether these are taxable or deductible. If taxable, then you will calculate DTA and DTL according to the tax, according to the asset or liability, and deductible if you will calculate according to the asset and liability. If deductible, then you will definitely calculate DTA generally. Okay, next, identify the exceptions if any. If there are any exceptions, we will deal about it in this video itself in the next PPT slides. Okay, if there are any exceptions, then in that case you never record temporary differences. Okay, and deferred taxes, excess the deductible temporary differences, tax losses and tax credits if any. You will adjust the exceptions if any. You will adjust the previous losses, unused losses, credits, etc. Next, you will determine the tax rate at which that particular tax, the deferred tax asset and liability should be recorded. Next, calculate and recognize the deferred tax. Accounting for the deferred tax will be done. It will be recorded in the books of accounts. Offsetting of deferred tax asset and liability will be allowed only on 2 conditions, whether it is legally permitted, and secondly you have intentions to settle the particular on net basis and show it on net basis. Okay, next, tax base of an asset. How is a tax base of an asset recorded? See, the fair value, the revaluation if any of any asset or liability is done, it is always done only for the accounting purpose, only for the accounting purpose. Okay, because the Ind AS specifically asks at specifically circumstances via its specific Ind AS that please fair value this particular asset, please revalue this particular asset. Are you clear? So this revaluation, this fair valuation is done only for the accounting purpose. Okay, are you clear with this? Now, if we talk about the tax base, you never ever include the effect of, the fair valuation and revaluation. Okay, so the tax base is always calculated on the cost basis and deduct the permissible expenses like depreciation and all. Okay, and for if we talk about carrying amount, you have to revalue it on the fair value as mentioned. Okay, see, the tax base of an asset is the amount that will be deductible for the tax purpose against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. The carrying amount of the asset could be either through sale or through use or through either use or partly sale. Tax base of a liability, same, is the carrying amount less the amount that will be deductible for the tax purpose in respect of the future liability periods. Okay. Next, if there is temporary difference, okay, so in respect of deductible you will calculate DTA. Okay, in case of unused tax losses you will calculate DTA, because further deduction will be allowed. If you will be allowed further deduction, then this is your asset, you will be having a benefit in future. If you will be having any economic benefit in future, then this is recorded as asset. Then carry forward of unused tax credits, you will be having further deduction possibility, and therefore you will be recording that particular as DTA. Whereas if we talk about DTL, there is taxable. This means you will be increasing the liability. Okay, next, identify exceptions. There was one step in which you need to identify the exceptions. After identifying the exceptions, what you need to do, you do not need to record the temporary differences and accordingly the DTA and DTL. the initial recognition of goodwill in the case of business combination step. Okay, so when goodwill is recorded, you do not need to record and calculate the carrying amount and the taxation amount differences. Secondly, the initial recognition of an asset or liability in a transaction which is not a business combination and at the time of transaction affects neither accounting profit nor taxable profit. If there is any certain transaction which is not impacting the carrying amount or the tax base, if it is not impacting either the accounting profit or the taxable profit. Okay, so if it is not making any sort of difference, you do not need to consider it while applying Ind AS 12, while calculating DTA and DTL. Okay, because you need to compare two things, and it is both the things are unaffected by this transaction. So this transaction serves as an exception of not applying this Ind AS 12. Next, temporary differences, if any, associated with investment in subsidiaries, branches, associate, and interest in joint venture. Next, important points. An entity should recognize deferred tax asset only when it is probable that taxable profits will be available against which the deductible temporary differences can be utilized. This is based on the principle of prudence and conservatives. Okay, it is said that you have to record that particular deferred tax asset only and only when you have a probability, you have highly probable chances that in future you will be having profits, economic profits, and therefore you will be able to recognize and calculate this DTA. Okay, you will be able to recognize and take the benefit of this DTA. Okay, you will record this DTA only and only when there is future expectation that there will be available good profit amounts. Okay, next, this is based on prudence and conservative approach. Okay, it should be noted that the entity has to make sufficient taxable profits in future. Not making losses will not suffice. Okay, it is very important that there should be high chances that the company will be making taxable profits. It will not be very much okay and sufficient that they will stop making losses. Okay, if they are not making no more losses, okay, this is not a sufficient condition to calculate and recognize DTA. Okay, probable means over here, probable chances means highly likely, more than not happening. Okay, so if it is probable, three criteria need to be met. Firstly, existence of taxable temporary differences there or not. Secondly, the probability of future profits is high or not, that you will be receiving future profits available or not. Okay, and next, availability of tax planning opportunities. Okay, next, important points. The following should be kept in mind. Deferred tax liabilities or assets should be discontinued. This is told as when DTL and DTA should not be discounted, not discontinued, discounted. This means that they will shown at the normal amount, will not be discounted, will not be multiplied with any present value factor. The carrying amount of the DTA shall be reviewed at each reporting date. At every reporting date, you need to revalue, remeasure and recalculate the DTA amount. Okay, ensure that the amount needs any change, then should be adjusted. Next, an entity shall reduce the carrying amount of a deferred tax asset to the extent it is no longer probable that the sufficient taxable profit will be available to allow the benefit of part or all of that deferred tax asset to be utilized. See, I told you that you need to have a high probability, high chances that you will be receiving profits, you will be having profits in future. Okay, it will be so sufficient that you will be able to compensate, you will be able to take benefit of the DTA that you have recorded. Only and only then you will be recording that DTA. Okay, in case in further subsequent annual periods, okay, when you are reassessing the DTA, you recognize that the future profits are not enough to take the benefit of DTA wholly or partially, then you need to limit the amount up to the amount of available profits. Okay, future available profits. Okay, for example, there are only 60% available, then you need to reduce that DTA up to 60%. Okay, you need to de-recognize the 40%. Are you clear? Because there is a very important condition that future benefits, future profits should be available so that this DTA can be charged against. Okay, if there is no expectation that future profits will not occur, okay, then you will not recognize DTA, or it is partial subsequently changed, then you will adjust the DTA amount subsequently, okay, in accordance with the available profits. See, again read, reduce the carrying amount of the DTA if in case to the extent that it is no longer probable that sufficient taxable profits will be available to allow the benefit of part or all of that deferred tax asset to be utilized. Either remove and de-recognize whole of the DTA or up to the amount that it is showing as per the available profits. But it should not exceed the amount that is probable or is forecasted to be in future profits. Okay. Next, any such reduction shall be reversed to the extent that it becomes probable that sufficient taxable profit will be available. Okay, it should be reversed off, which was booked previously should be reversed off if circumstances change. If dividend paid, then current tax and deferred tax assets and liabilities are measured at the tax rate applicable to the undistributed profits. See, if it is announced, okay, dividends are announced, then it should be recorded and taxed at the amount that other tax rates are going on, okay, on other incomes and expenses. You should not record at the separate dividend taxes, okay. But in case if it is finally paid off, finally announced, and if there is any change, then that change will be recognized, and if excess has been recognized, then it will be reversed off. Okay, are you clear? Next, deferred tax arising from business combination. Yes, on business combination there might arise DTA and DTL. Firstly, it is always adjusted towards goodwill. Any DTA or DTL whenever arises on business combination needs to be first adjusted as per the goodwill. If you relate it with the impairment loss, okay, what we used to do, whenever there is impairment loss in case of business combination, what you needed to do, you needed to first charge it towards the goodwill. You write off the goodwill. Even if there is excess above the goodwill amount, then you what you did, you charge this impairment loss, the remaining impairment loss, in the carrying amount of the non-current assets, okay, or the remaining assets. Are you clear? Here also, if any DTA or DTL arises and there is goodwill, then it is first adjusted over there. For example, there is a goodwill, for example, okay, of rupees 500, for example, okay, and there is a DTA of rupees 100, okay, arises afterwards. Now, how you need to show? You will show, how come? Goodwill just 400 rupees and the DTA, okay, will be 100. This will be debited. This will be debited. Are you clear? In case if there is a DTL, if there is DTL, for example, of rupees 50, then what you needed to do? You need to reverse, add this goodwill. Okay, for example, you will do goodwill debit to DTL. Okay, this DTL amount 50 and to PC. Okay, on business combination it is always done to purchase consideration, that is 500. Here the purchase consideration will be 450. Okay, and the goodwill amount will be 500 plus this DTL amount, that is 550. Are you clear? And the net asset will be there. Are you able to recognize this? Are you able to record this? If there is DTA or DTL, it is first adjusted towards goodwill. Since goodwill is your asset, then DTA is there, then you will remove that goodwill portion and recognize as DTA. Okay, if there is DTL, then since it is liability, it will be added to the goodwill. Are you clear? Are you clear with this? When you will be checking the ICI questions in the next lecture, you will get to know the exact accounting treatment, how you are recording for the business combination. Okay, here those deferred tax assets and deferred tax liabilities affect the goodwill or bargain purchase gain the entity recognizes should affect the goodwill first, should be treated against goodwill first. Are you clear? Are you clear? Good. In case of doubt, please let me know. Please comment down below and let me know in case if it is clear or not. Okay. Next, any expense if charged to OCI okay, any expense which is related to OCI, then the tax related to that particular item will also be charged to OCI item, that is other comprehensive income. Okay. Next, business combination, very important. Even ICA question is there. Having control, that is more than 50%. If you are having a control over it and you have announced something, for example, okay, so this means since you have control over that particular announcement, this means you can change that particular announcement. Are you serious? Then this means if due to that such announcement obligation arises, okay, since you have control, then such obligation can be avoided, can be cancelled, such announcement can be cancelled. Since you are having wholesale right, wholesale control, then this obligation is not mandatory, it can be avoided, and therefore you will not be creating any sort of provision. Whereas if we talk about here, when the business combination is there and you are not having enough control, okay, to impact the decision taking, so once the announcement is made, okay, and it leads to any obligation, then this obligation is unavoidable, will not be changed, and therefore you will have to create a provision. Okay, similarly goes for DTA and DTL. Next, disclosure explanation of relationship between tax expenses and accounting profits. You have to compare the accounting profits and the accounting and the taxation profits. You need to make a reconciliation and explanation why these are different. What is the difference and why they are different? You also need to present a reconciliation, a numerical reconciliation about the tax expenses, okay, and the product of accounting profit multiplied by the applicable tax rate. Whereas also you need to recognize and reconcile the average effective rate. Average effective rate also needs to be taken. For example, there is a 20% tax rate, okay, and in addition to this you have to create a DTL or DTA of for example 3 rupees, okay, or 3% more. Then 20% was initially your tax rate. Now 3% have to be added because of this DTA and DTL, and therefore your effective rate becomes 23%. So you also need to show as a disclosure this reconciliation of your effective rate. That is, how did it became 23%, from 20 to 23, how did it became, what was added, what was deducted, why it was added, why it was deducted. You need to prepare a reconciliation, okay. Even the differences between the accounting profit and taxation profit needs to be recorded and shown off, okay, as a reconciliation. Next, disclosure in change in tax rates. Simply, if there is a tax change rate, okay, tax change has been the tax rates has been changed, then what you need to do? You need to record it at the current rate itself, and the change rate will be applied from the date it becomes effective, okay. But in this case, between this, you have to make a disclosure about the effect of the change of the tax rate, okay. The applicable tax rate may change due to variety of reasons, okay. There could be a change in the manner of recovery of the asset. The tax law may have changed. There could be a change in the structure of the entity. There are multiple reasons due to which there can be tax change rate, okay, tax rate change. In case there are changes in the applicable tax rate compared to the previous accounting period, an explanation needs to be provided. It needs to be recorded at the previous rate. The new rate should be recorded from the date it becomes applicable, it becomes announced and notified, okay. In between this, if there is approval period and pending period, then you need to disclose about the same, that there has been change in the tax rate and its impact should be shown in the disclosure portion. Next, disclosure of any unrecognized deductible temporary differences, unused tax losses and unused tax credit. If any, then you need to make a disclosure about the same, how these are being used of, okay. The standard lays down the criteria, for example, whether a sufficient taxable temporary difference is available, is there a probability of future profits, and whether any tax planning opportunities are there. If yes, then you will be recording that particular deferred tax asset and all, okay. If these particular criteria are not met, that means there is no probability that future profits will occur and all, okay. If this is the case, then you will not be recording that particular DTA. Whether you are recording or not recording, you have to present a disclosure that why have you recorded this DTA, on what basis. You have to give explanation about that in the disclosure portion. If the laid down recognition criteria could not be met, in case, then reversal needs to be met, Okay, no DTA is recognized on these deductible temporary differences, unused tax losses and unused tax credits. Okay, if the criteria is not met, either you will not record it. If recorded and further on subsequent the criteria are not being met, then you need to reverse the particular same amount that you have recorded previously. Okay, next the standard requires the amount and the expiry, if any, to be disclosed. For example, if we talk about income tax losses, these are carried forward for 8 years, and exceptional cases these are carried forward only for the 4 years. Okay, so you need to disclose the amount of taxes of the losses. Okay, what amount and up till what date it will be carried forward, up till what date it will expire, you need to disclose it off. Okay, and lastly, other disclosures. There are list of other disclosures that need to be made while applying Ind AS 12 in your financial statements. Temporary differences associated with investments and subsidiaries, amount of deferred tax liabilities, discontinued operation, dividend taxes. In case of business combination, also you need to make a disclosure. Deferred tax asset evidence thereto where based on future taxable profits, tax consequences of distribution of the dividends, and finally the tax related contingency. These all need to be disclosed of in your books of accounts. Okay, that's all about the Ind AS 12, its concepts. Okay, we have discussed the income taxes. Please watch the next video thoroughly. Please, we will be applying this particular standard on the ICA questions. Okay, and that particular solving practical questions will give you a practical insight about the applicability of this Ind AS. Okay, if you like the video, please like it. In case of any doubt, dislike, please comment and let me know. Your feedbacks are very valuable. Okay, see you in the next lectures. Till then, take care, be safe, stay tuned. For more course, to enroll for the whole course, don't forget to check out the description box. Okay, the link for the same is given below. Also, you can follow us on Instagram and DM us with any sort of query or doubt or any suggestion. Okay, we are open for that. Thank you. See you in the next lecture. Bye bye.